You've probably heard the fantastic stories. Did you know Mohan uncle down the road bought a few hundred shares of Infosys and now it's worth a few crores and now he's going to buy a Ferrari? Okay, that last part was unbelievable, but the first part is actually true for a few people. The thing is, it took quite a bit of courage and conviction for those people who bought Infosys in 1993 and even more to hold it for these 30 years. It's a proven fact that equity is the best way to create long-term wealth. And while we often talk about the merits of investing in mutual funds, the dream is to build a stock portfolio of your own, something that will stand the test of time and create generational wealth. The question is, how does one construct such a portfolio? There's no one answer, but there are a few principles that you can follow to get on the right track. Welcome to MoneyWise. I'm Alex Matthew. On this show, I'm not going to ask my guest today to give you multi-bagger ideas, but I am going to ask him how he goes about constructing his own portfolios. Because who better to ask than someone who is paid to do it? Joining me on the program is Nimesh Chadan, the Chief Investment Officer of Bajaj Finserv AMC. Thank you so much, Nimesh, for taking the time.
My pleasure, Alex, to be here.
I'm glad to have you. I want to, over the course of this conversation, like I said, help people who are intending to or who are constructing their own stock portfolio. But before we get started on all of that, you've had a more than 2-decade journey in this space. You've been a sell-side analyst, you've been a fund manager, you are now CIO. What have you learned over this period, and how has your own method distilled into what it is right now?
The journey in investment is a journey of learning. I remember when I started my career, it was about chasing that exciting story or narrative on the street and seeing if it can become a multi-bagger. And then over the years, it's evolved that you follow a certain process for investing and stick to it with discipline. And then multi-baggers automatically come. So as I think in one of the movies, it said that खुद काबिल बनो तो कामयाबी खुद तुम्हारे पीछे दौड़ेगी. So it was about learning that it's about oneself rather than just chasing exciting stories.
Give me examples of these exciting stories that you chased in the early part of your career.
Many of them. So earlier, like any average investor, if you see a stock moving up, becoming a multi-bagger, you want to participate in that story and you regret not identifying it at the bottom, but you only feel relaxed once you participate in it, even if it is at a high valuation. And then unfortunately, the compounding process works like this, that if you buy something at a very high price, you don't get good compounding, and many a times the worst case scenario is you lose a lot of money. So after going through that greed and fear cycle, moving with the pendulum of the crowd, you finally stop and realize that if you don't stand for something, you will fall for everything. And that's where learning about behavioral finance, constructing a good investment philosophy and process, that kind of dawned on me. And luckily learned very good lessons in the first few years. And
so you mentioned behavioral finance. What does that entail?
So behavioral finance is a branch of behavioral economics. It is about psychology investing, psychology affecting your investment decisions. And if you see books like Intelligent Investor, where most revered Benjamin Graham writes in the very introduction that in this book we'll be talking a lot about the psychology of the investor, because most of the time the chief enemy of the investor is himself.
Right.
So behavioral finance touches upon all biases, emotions that can impact your investment decision making, and in a way helps you be a better investor.
So give me a few examples of this, because often we talk about herd mentality. You just talked about the implications of herd mentality, the desire to participate. I mean, of late you've been calling it FOMO, but then ultimately it is herd mentality. What else is there?
So there are many biases. So I've studied about 83 of them.
83, but we don't have the time to talk about 83 biases.
So the most important biases, apart from greed and fear, which are mainly about overreaction on the greed side of positive and overreaction on the negative fear. There are some of the important ones are like confirmation bias, where you just look for data that confirms your theory. Overconfidence, where you approach the market that I know everything and you leverage and you then lose money in that. And third would be loss aversion, where every 100 rupee loss pains you almost double of the happiness that you get for making 100 rupees. So these
But
are
you
the
have to
important
lose
ones.
to win, right? Is
Well,
that true?
Learning is better in bad markets. When the markets are in a downturn, you learn a lot. Like you only switch to healthier habits when you fall sick. So it happens like that, but it doesn't mean that you have to keep making losses to create wealth. So it's not like that. Better to learn in one cycle.
Okay, so let's speak about the fundamental principles of building a portfolio. And ultimately, what I'm hoping to achieve through this conversation is either setting a few bad habits right, or helping somebody down the path where they've decided to make a start right now and they're constructing a portfolio. So you've written about mega trends, and you've written about the fact that this approach of identifying mega trends is a combination of multiple approaches. It's not necessarily bottom up as they talk about when you're selecting per company, or a top down approach where you're studying overall market and you're saying what's standing out there. How would you describe this mega trend approach?
So mega trends are long-term changes that impact businesses, economies, and companies. The genesis of the thought was that we all often talk about buy and hold strategy in equities.
Yes.
But when you're looking for longer term, say 15, 20-year investment, the number of changes that economies and businesses grow through technology changes, regulatory changes, economic changes, social behavior changes. Sometimes the reason you invested in a business in the first place starts fading, or it just changes. So how do you think of long term, but also keep a watch on these changes that are happening? So mega trends investing changes buy and hold into buy and watch.
So let's go to our first example. We talk about Infosys. You don't necessarily have to talk about Infosys per se, but in our example, we've talked about the creation of significant amount of wealth, because at that time, Infosys was a significant disruptor. It was the pioneer, or it was the first few companies that were stepping into the IT space in India. And it made waves at the time. Of course, over the course of the next few decades, it did as well. But now we're talking about certain companies, particularly in the FMCG space, or you're talking about companies in the paint space, without naming anybody, where people are saying, look, I've had a significant amount of patience over the last 3 or 4 years. This buy and hold strategy does not seem to be working too well. Is that what you're talking about?
So the buy and hold strategy tests you a lot. So even in the example we gave about Infosys, on April 10, 2003, Infosys was down 40% in one day.
Yes.
So it took a lot of patience and conviction to hold on to that good business when it was crashing like that.
And people did, not just the imaginary Mohan uncle.
Absolutely.
People did hold on. Yeah.
So identifying a good business to invest in is one thing, and then sticking with it when the market has its mood swings about that business is completely another thing. Infosys, the IPO was actually undersubscribed as far as I remember it. Right?
Yes.
So people were skeptical, and that's why the valuations were attractive.
And those investors, the large investors, of course, that invested at that time have become household names now and revered in the market.
Absolutely. So every business goes through its cycles. We try to identify mega trends that will last for many years.
Yes.
So if I take the IT example again, during the 90s, you saw two important mega trends mixing up together, where technology changes made it easier to work from an offshore location. And India, having this demographic benefit, we had large, young, English-speaking population who could be trained for software development.
Yes.
So the meeting of demographic trends and technology trends led to the birth of the IT offshoring industry in India. And you benefited from that. The same thing in consumption for now, if we talk about the recent past. Consumption companies had a bad quarter.
Yes.
But if you see the growth in consumption companies, or the projected growth in consumption companies for the next decade, it's huge. We have just crossed $2,500 per capita income. There's a long way to go, and we are still the fastest growing country even with this growth rate. So there's a huge runway, companies with strong competitive advantage. If they are going through some short-term trouble, they become attractive buy opportunities.
Interesting. So how do you identify these mega trends, and why is it a combination of multiple schools of thought?
So we identified 6 sources of megatrends. Here we are looking for changes which will last at least 3 to 10 years, kind of. So we need to be at least seeing some visibility of this trend unfolding. So let's take the 6 sources, which are TRENDS. So,
Trends, okay.
So technology changes, regulatory changes, economic changes, nature or sustainability changes, demographic changes, and social changes.
Fairly simple to remember.
Absolutely. We wrote a small book also on it.
Okay.
So we look at these areas to spot which are the big changes that are happening. In technology, say AI, electric vehicles, UPI payments, all those. So we pick up these trends, overlay them on all the sectors, and see which companies are on the right side of the trend and which companies are on the wrong side
Behind
of the
the
trend.
time, yeah.
So we pick up those companies as a universe, that these are the companies positively impacted. And then we have to check what you mentioned in the beginning, the bottom-up side.
Yes.
Where these companies have a potential to do well, but do they have the ability to do well?
Right.
So that's where we check their business, management quality, the financial needs of that company to grow and use that trend or monetize that
The
trend.
amount of debt they have, the cash position, all of those factors.
Yeah. So if you see, we are combining the top-down and the bottom-up here.
Yes.
Top-down for universe selection and bottom-up for identifying the ability of companies to...
Speak about the rest of the trends acronym.
So, regulatory changes,
Yeah.
you can look at the resurgence in manufacturing in India.
Yeah.
A lot of sectors benefited from the PLI regulations that came in. Also, internationally, some of the countries have regulations about higher import duties on certain Chinese
China
products or so.
Yeah.
That gives India the benefit
In the
of that
chemical
trend.
space or in the textile space.
Absolutely.
Yes.
Economic changes are about per capita income, the growth that we are seeing, and where we are in the economic cycle, and where India is actually on a very strong footing. Nature and sustainability changes are about higher taxes on, say, certain polluting industries and incentives to companies that are providing solutions
Kind of like
to that.
ESG, no?
Bordering on that.
Okay.
So ESG is included within these trends rather than being a separate part.
Sure.
And
D.
D is the demographic changes. A young population, in terms of its savings habits and spending habits, is very different from an older population.
Yes.
So India is benefiting from that too, the demographic dividend that we have. Social changes are about consumer behavior or people's behavior. So there was this data that showed that because of selfie cameras being better and people using a lot of social media, cosmetic sales have moved up quite a bit. So these are some of the social changes that people love posting these photographs on social media.
I realized this week, Chandan, and it struck me all of this year, I've realized, and last, you've had some very large international music artists come and perform in India in a few cities. And I mean, of course, Coldplay and the tickets getting sold out and all of that. What I'm seeing, and maybe you can talk about whether you've seen this as well, is that young people today are focused on the experience and they're okay to pay 5,000, 7,000, 10,000, 12,000 rupees for a ticket for one day, which will be about 4 hours, but they want that experience.
Absolutely. So this generation is looking for more experiences than assets.
Yeah.
If you take every big change that is happening, so for example, quick commerce, people are ready to pay a small fee to get something in 10, 15 minutes. And now the expectations are that you will deliver in 15 minutes.
Yes.
So the rise of quick commerce, the concerts and the spending on entertainment, the spending on travel. I remember when I used to be young and going to buy a suitcase for travel, the store looked like a go down. Now you have a showroom with mirrors and all to see, like, how the bag looks placed alongside you.
Yeah.
So this generation...
You got to maintain the airport look, didn't you know, Nimesh?
Absolutely.
Yeah.
So these changes are helping certain businesses. You had to identify which are the businesses that are with the right model and management to capitalize on them. Of course, valuation becomes very important when you're investing. And picking up companies at the right valuation makes them great investments. Otherwise, great companies at wrong valuations may not be great investments.
Okay, so let's delve into a couple of these concepts. First of all, of course, talk to me about some of these megatrends that you've seen emerging and as they stand right now, when you look at, as you pointed out, from here to the next 3 to 10 years.
So there are quite a few that we have identified as a team and we invest in them. Let me give you 2 or 3 which comes as an important trend.
Yeah.
Power sector is an important trend for us, because any technology change that is happening, whether it's electric vehicles, data centers, semiconductors, they are all power intensive businesses. And hence the world is actually facing shortage of some of the equipment like transformers and all for this.
Yes.
So grid has to be renewed. You need to have high-end transformers and equipment to handle this kind of power. So there are few set of companies that have a long runway of growth in this area. So that's a big bet for us.
But traditional or renewable, which according to you is?
So some businesses have adopted or upgraded themselves to even address the newer needs. So for example, while utilities have a certain, say, coal-based or thermal-based plants, there are companies, the same have set up renewable facilities also. And obviously, this becomes a little technology intensive also. So companies that have upgraded in technology are able to address these demands much better. The second big trend we see is contract research and manufacturing. The pharmaceutical contract manufacturing in India. We are becoming a pharmacy to the world.
So
and a lot of outsourcing, APIs.
APIs
are being outsourced to India. So that's a big trend.
API and CDMO basically. Yeah.
And regulatory changes are also helping here. The Biosecure Act, which was tabled in the US, I think will have a big impact on Indian CRAMS businesses.
So we've been using a lot of abbreviations here. Just a very simple thought, in case you were wondering, this is the pharmaceutical industry that we're talking about. And if you are familiar with how the auto industry works, and you're talking about what the auto ancillary companies are to the pharmaceutical companies, you're basically talking about how these API companies or CDMO companies, contract development and manufacturing organization companies they are to the pharmaceutical companies. So on that aside, we were talking about that.
The other is this new generation looking to upgrade in terms of consuming better, consuming a better brand, consuming more frequently. So these are some of the trends in the consumption and the discretionary segment that we are bullish about. So travel, as I mentioned, is one. Upgrading to, say, luxury cars, automobiles, or let's say within regular consumption, moving from unorganized to organized, unbranded to branded. So those, say, even in rural areas, the frequency of consumption going up as income levels rise and penetration of goods and services increases.
So, but you're talking about things like toothpaste, and you're talking about various other things like that, or you're talking about something that is more nuanced?
So everything from daily use groceries and like toothpaste. For example, in toothpaste, only 1% of the population brushes twice a day.
Yes.
So there's a huge headroom for growth, even in a small area like toothpaste.
Yes.
But from there on to real estate, where people are moving to more premium developers, larger properties, even the interiors that they are using, the building material that they are using is moving from unbranded to branded, and people want to actually be proud of what they have created for themselves. So the entire chain of consumption is benefiting from this change in per capita income and the aspirations of people to consume better.
So a lot of what you're saying is actually visible if you step out onto the street and just pay a little attention to what you are consuming yourself, if you are part of a growing cohort of people, or if you are seeing people consume things that they didn't consume perhaps 2 years back. But the question then comes about to say that if you have identified this, you know for a fact that several other people have as well. And sometimes the prices, as you pointed out, are just a little too expensive. How do you identify if it is too expensive? Because sometimes you're buying a company where the growth has been priced in for the next 3 years.
So I think, as Warren Buffett said, that investing is simple, not easy.
Yes.
It requires a lot of effort and research. Ideally, you have to get to a point where you have an intrinsic value determined of a business, and you also know what the crowd is expecting from it. There are times when crowd expectations are much higher than what you have assumed as the intrinsic value of that business, and they may be overvalued. And sometimes it's the other way around. One of the ways of getting around it is when there is a particular concern, a short-term concern in a sector or a good business, they become available at a lower valuation, because typically the investors are more short-term oriented. They look at recency bias or news flow which are very recent, and if they are negative, they just dump a good business, even like, if it has a good runway for
But
growth.
Chandan, in your experience, do you always get an opportunity? So your first step, of course, as you've pointed out, is to identify your universe. You will like 2 or 3 or 4 companies in the consumption space, but you don't know, you've not yet pressed the trigger and you've not yet bought. Do you always get an opportunity?
Almost always, I would say. Not in a very euphoric market, but typically you can classify opportunities into market-wide or sector or stock-specific. Market-wide opportunities during, say, a more global or a domestic issue, you find a market-wide correction and that gives you an opportunity. But always in the market, because human nature is such that people get attracted to hot stocks, glamorous stocks, and they chase those, there is always some sector or set of businesses which are ignored by the market, and that's your fishing ground.
Okay.
So that's where you get more fishes and less water.
And so, okay, I like the analogy, but in that scenario, what I'm assuming that you are not yet saying, and you will talk about now, is when you should sell, because ultimately when there is one place where you're getting more fish and less water, there will be another place where there's no fish at all.
Yeah. So again, depends on the type of investor you are. Good businesses, as long as your assumptions about those businesses are unfolding as expected, despite the cycle that they go through, they should be held on for a longer term.
Yes.
It is easier to buy, but difficult to sell. Easier to buy because certain mathematical parameters of valuation will tell you when something is cheap.
Okay.
But how expensive something can get is very difficult to determine. There are times when good businesses may go into overvaluation, higher than the intrinsic value for a short period of time. And then they will get corrected, or the growth in the business will justify it.
And sometimes you should be okay paying that. Is that fair? Because if you look, and if you're buying for example, if you're buying for 10 years, does it really matter how it's going to react over the next 1 year?
So when you are paying a higher valuation for future growth, you need to be very sure about the growth.
Sure. Okay.
And one way of being sure about the growth is using what mega trend is supporting that business. So anything you want to hold, so if you close your eyes and think, these are the 5 stocks I want to buy for the longer term.
Yeah.
Most of the time, these will be stocks that you feel will have a good future.
Yes.
Right? That they will grow faster. All you need to do is support that with some raison d'etre. Like, this is the reason why this business will continue to grow faster. And if it is backed by a good mega trend, then you should hold on.
In your opinion, if an individual, and of course you're a fund manager, and so you have certain factors that will determine the size of your portfolio, not least of which is how much money people are giving you to manage. But in an ideal situation, if you were an individual and given the kind of experience that you've had and you were to build a portfolio, how many businesses would you own?
So finding good businesses with good management at the right price, right? It's a path of accumulation rather than just making the whole set right
Making
now.
a portfolio, yeah.
Right?
So, yeah.
So there could be certain themes which are trading at a good discount right now, and you want to just buy those themes, and you may pick up more businesses from there. But over a longer term, you will find that through these market fluctuations and gyrations, and as a longer term investor, you should learn to enjoy them. You collect these good businesses over a period of time. Because at some point of time, during a down cycle, people would hate those businesses and throw them to you at a very good valuation. But if you were to make the portfolio right now, at this point of time, obviously, you would first want to look at the quality of businesses and then what kind of upside is left in that business. It should have some upside to qualify in your portfolio.
So, okay, but let me ask you this. How many companies is too many to hold?
Again, it's different for different investors. I believe about 30 companies in Indian businesses. You should have about 30 companies in the portfolio. That would give you reasonable diversity in terms of, because India is one country where you have many different stories, many different sectors contributing to the earnings growth and the economic growth.
Yeah.
I mean, as an investor, this is a beautiful place to be.
Yes.
Right? You can pick up very good businesses from across sectors.
Yes.
And that portfolio of, like, the best gems in, say, each sector about 30 of them, I think, should be.
We haven't spoken about this very important part, which is risk and managing the risk in your portfolio. And you do this on an ongoing basis. You have a team that studies this as well, including yourself. But one part of that is too much concentration in one particular business or company, and maybe even buying it at the wrong price. But how do you avoid that concentration if you're talking about an individual stock portfolio?
So this requires a bit of science. So investing is a combination of science and art. And allocation is where you can use certain models to allocate better. So internally, we use something called Kelly's criterion, where for each company, we create a bull bear case scenario and certain probabilities of what can happen for this company. And then we put it into this model. So this model gives us a sample portfolio that, based on the upside and the downside, this is the allocation, or this is the concentration you should have. Allocation is one area where I think more and more use of, say, AI or some of the models will be more initially before it gets into selecting businesses.
Fantastic. I think we've covered quite a bit of the bases that somebody would need when they're going towards the investing journey. Thanks so much, Nimesh, for joining and for speaking to me.
Pleasure being here.
On MoneyWise. And that brings us to the end of this edition of MoneyWise. Of course, we couldn't possibly answer all of the questions that you would have with regard to investing. Hopefully, over the course of the next few weeks, we will manage to cover a few more bases. Hopefully, we set you along the path that you need to go to being a successful investor. Do stay tuned, lots more coming up on NDTV Profit.